Hello everyone. I am making a free lecture series on most probable questions for UPSC 2025 prelims on all the major subjects like geography, polity, economics, environment, and this video will be uploaded one by one. Through a deep research and deep PYQ analysis, I have identified some of the topics which has very high chance to be asked in this year. So let's start with today's first lecture on economics. There will be 3 videos for economics and this is the first video. And one more thing is, through this video, I will just show you the probable topics and give you an overview of those topics. I will not explain in detail. So what you can do is take a notes of those topics and revise according to your need and level of preparation. And I have uploaded the PDF file of this lecture in my Telegram channel. Link is in the description. Go and join the Telegram channel. And now let's start with our first trouble topic for this year is Basel norms. And one more thing is, the list of the important topics will be in the last video of each subjects. So follow all the lectures. And now let's start with today's topic is Basel norms. So the Basel norms is an international guideline for banks to enhance risk management, financial stability, and capital adequacy. These Basel norms are up to the individual countries to adopt and implement those norms through their own regulatory framework. And this is not legally binding. Till this date, there are 3 Basel Accords: Basel 1, Basel 2, and Basel 3. Now, move to our next topic, external benchmarking. External benchmarking is a linking interest rate on loans to the external reference rate rather than the internal benchmarking which are set by the banks. It enhances the transparency and efficiency and faster transmission of the monetary policy whenever it changes by the RBI. There are some key provisions. All new retail loans and MSME loans must be linked in the external benchmarking. Bank must reset interest rate at least once every 3 months. Whenever RBI change their repo rate, it will directly impact the loan rates also, and it enhances the transparency level to the borrowers. So they will get a higher pricing of loans. So the next topic is MCLR. MCLR stands for marginal cost of fund-based lending rate, which means minimum interest rate at which bank can lend to the borrowers is known as MCLR. It is introduced by the RBI. It helps to improve the transparency in the lending rate and ensure better transmission of monetary policy. There are some key features. The rates are not fixed. They can vary according to the tenure of the loans. And MCLR can be changed every 6 months or 1 year. Loans are reset periodically, means borrowers' interest rate can be changed based on their updated MCLR. And this MCLR held to the repo rate adjustment. Whenever RBI adjusts their repo rate, this will directly impact to the borrowers. Okay. Our next topic is RBI as a regulator. We all know RBI in our country, it plays a very crucial role for financial stability, economic growth, and monetary control. There are some key functions of the RBI as a regulator. RBI issue banking license, implement capital adequacy norms like Basel norms. It conducts banks inspection and audits. Also, some tools like repo rate, reverse repo rate, CRR, SLR, they are introduced to control inflation and liquidity. Also, RBI supervise NBFCs and UCBs. RBI issue currency notes except on rupee notes. RBI regulates the forex market and manage the exchange rate and forex exchange reserve, promote the financial inclusion. And there are some sectors in which RBI makes a regulation and regulating those institutions like commercial banks, regional rural banks, cooperative banks, NBFCs, and payment banks and small finance banks. But there are some institutions where RBI don't make any regulation, like insurance companies, stock markets, and pension funds. Okay, now move to our next topic is the RBI Retail Direct Scheme. So RBI Retail Direct Scheme is a scheme where an individual invests directly to the government securities like treasury bill, sovereign gold bond, and government bonds. Retail investors can buy and sell the government securities without any intermediators. Also, these government securities can be sell in the secondary markets. Government security provides a fixed interest rate, so there is a low risks. Now our next topic is PM Mudra Yojana. So PM Mudra Yojana is a collateral-free loan scheme to the micro and small enterprises, and this will mostly focused on the women entrepreneurship, SC/ST, and weaker sections. In Mudra Yojana, there are no collateral needed or any guarantee needed. and up to 5 years the repayment period will be provided for this. And one more important thing is this Mudra Yojana is not for the farming activities and not for large businesses and real estates also. Now, the Unified Pension Scheme. These schemes offer central government employees an alternative and existing national pension system aiming to provide assured and structured retirement benefit. After 25 years of service, 50% of their average basic pay will be paid, and any unfortunate event, the family will be entitled to 60% of the pensions of the employee was receiving. And this UPS Unified Pension Scheme is indexed to inflation so that it will adjust the inflation rate also according to time. Now the next topic is tax to GDP ratio. Total tax revenue collected by the government as the percent and the total GDP of the country, the ratio between this is a total tax to GDP ratio. It indicates the tax efficiency and revenue generation capacity of an economy. High ratio means strong physical health, low ratio is weaker health, weaker tax collection. So our next topic is credit guarantee scheme. This is a government initiative to provide collateral free loans to the micro, small and medium enterprises. It's also without any pledging of asset like Mudra scheme, and up to 5 crore the borrowers can borrow in a single borrowing. Next is physical deficit. The difference between the government's total expenditure and its own revenue excluding the borrowings in a financial year is physical deficit. Physical deficit is total expenditure minus total revenue excluding borrowing is the physical deficit. A government manage this physical deficit by deficit financing, which means borrowing from RBI, issuing government bonds, reducing subsidies, improving tax collection, and disinvestment of PSUs. In such way, the physical deficit can be managed by the government. Our next topic is government debt and national debt. The total borrowing of a country's government is the government debt. Both internal and external debt are calculated in this government debt. Internal debts are like treasury bill, government bonds, and external debts are foreign bonds, loans from World Bank, IMF. Okay. Next is national debt. National debt is like a government debt plus private sector debt plus external borrowing. All together is uh, known as national debt. It's a total financial liability of a country. Today's last topic is revenue and capital. So, revenue and capital are two key classification of income and expenditure in government budgets. So, revenue receipt or revenue income is without increasing liability or reducing asset when money is received by the government is the revenue receipt. And other hand, the capital receipt is when government make a when government create a liability or reduce asset to receive money is known as capital receipt. Revenue receipt examples are like income tax, GST, dividends, and capital receipt examples are loans from RBI, World Bank, selling PSUs or PSU shares. In revenue receipt, there are no repayable incomes, but in capital receipt, it makes a liability to the government or to the country. And revenue expenditure means spending that does not create asset or reducing liabilities like salaries, pensions, interest payments, subsidies, which will not create any asset to the government. But the capital expenditure is spending in those which create assets or reduce liabilities, like investing in highways, railways, airports. This will create an asset to the government and to the country. So the revenue expenditure does not contribute to future income, but in other hand, capital expenditure create a long-term asset. In capital expenditure, one time or long-term investment is there, but in revenue expenditure, there should be a recurring paid. A high revenue deficit means the government is spending more on recurring expenses rather than the investing in the infrastructure. A high capital expenditure is generally good as it is boost economic growth. Okay. So today there was these 12 topics. I hope you note down those topics and you will revise according to your need. Okay. Then we will meet in our next lecture. Thank you.